99% of traders use the moving average. They plot it on their charts, wait for the crossover, take the signal, and then wonder why they keep losing money. What if I told you the indicator isn't the problem? What if the real secret is something almost nobody teaches? Today, I'm going to show you why most traders completely misunderstand the moving average, how professionals actually use it, and why this simple shift in thinking could transform the way you trade forever. The moving average indicator is one of the first tools every trader learns. It's simple, popular, and found on virtually every trading platform in the world. Yet, despite its popularity, the vast majority of traders never unlock its true value. They treat it as a buy signal, a sell signal, or a magical line that predicts market direction. That's where they go wrong. In this video, we're going to break down the biggest misconception surrounding the moving average indicator. You'll discover why chasing crossovers often leads to frustration, why successful traders focus on context rather than signals, and how the moving average can become a powerful tool for understanding market behavior instead of predicting it. The difference between struggling traders and consistently profitable traders is rarely the indicator they use. More often, it's how they think. And once you understand the real purpose of the moving average, you'll never look at it the same way again. One of the biggest mistakes traders make with the moving average indicator is believing that it can predict where the market is going next. This misunderstanding causes countless traders to enter trades with unrealistic expectations, only to experience frustration when the market behaves differently than they anticipated. The truth is that a moving average was never designed to predict future price movements. It is a tool that summarizes what has already happened. Yet many traders treat it as if it has the power to forecast the future, and that single misconception is often enough to damage their trading performance. When traders first learn about moving averages, they are often told that if the price is above the moving average, the market is bullish, and if the price is below it, the market is bearish. While there is some truth to this idea, it is only a small part of the bigger picture. Many beginners quickly develop the belief that the moving average itself is creating trading opportunities. They start buying simply because the price moves above the line and selling simply because the price moves below it. What they fail to understand is that the indicator is only reflecting information that already exists in the price action. A moving average is calculated using past prices. Whether it is a 20-period, 50-period, or 200-period moving average, the indicator is always looking backward. It is smoothing historical data to help traders see the overall direction of the market more clearly. Because of this, every signal generated by a moving average is naturally delayed. By the time the indicator confirms a trend, a significant portion of the move may have already occurred. This delay is not a flaw. In fact, it is one of the indicator's greatest strengths when used correctly. The problem arises when traders expect it to do something it was never designed to do. They expect certainty. They expect precision. They expect the indicator to tell them exactly when to buy and sell. Markets do not work that way. No indicator can eliminate uncertainty because uncertainty is a permanent feature of trading. Professional traders understand this. They do not look at a moving average and assume they know what will happen next. Instead, they use it as a tool to understand what is happening right now. The indicator helps them identify the current trend, assess market momentum, and determine whether buyers or sellers have been in control over a period of time. It provides context rather than predictions. Think of the moving average as a map rather than a crystal ball. A map can help you understand where you are, but it cannot tell you exactly what will happen on your journey. In the same way, a moving average helps traders understand the current market environment, but it cannot guarantee future outcomes. The traders who struggle are often searching for certainty in an uncertain business. They want a single indicator to provide all the answers. The traders who succeed accept that no indicator can predict the future. They use the moving average as one piece of evidence within a larger decision-making process. Once you stop treating the moving average as a forecasting tool and start using it as a context tool, your entire perspective on trading begins to change. That shift alone can separate a disciplined trader from the 99% who continue chasing signals that were never meant to predict the future. One of the most popular ways traders use moving averages is through crossover signals. The idea is simple. When a shorter-term moving average crosses above a longer-term moving average, it generates a buy signal. When it crosses below, it generates a sell signal. On the surface, it sounds logical and straightforward. This simplicity is exactly why crossover strategies have become so popular among retail traders. However, it is also why so many traders end up disappointed. The reality is that moving average crossovers fail far more often than most people expect. especially when they are used without understanding the conditions that make them effective. The first reason crossover signals fail is because they are based entirely on historical data. Both moving averages are calculations of past prices. Since they are both lagging indicators, the crossover itself occurs after the market has already moved. By the time the signal appears on the chart, the market may have already completed a large portion of its trend. Traders who enter at that point are often arriving late to the party, buying after much of the momentum has already occurred or selling after much of the decline has already taken place. Another major problem is that markets do not trend all the time. Many traders assume that because crossover strategies work well in trending conditions, they should work consistently in every environment. This assumption leads to losses. Financial markets spend a significant amount of time moving sideways. During these periods, price fluctuates back and forth within a range without establishing a clear direction. As price moves around, moving averages repeatedly cross each other, generating multiple buy and sell signals. This creates what traders call whipsaws, a series of false signals that can quickly drain both capital and confidence. Many traders blame themselves when crossover systems fail. They think they chose the wrong moving average settings or entered at the wrong moment. In reality, the problem often lies in the expectation that a crossover should provide reliable signals regardless of market conditions. No moving average setting can completely eliminate false signals because the market itself is constantly changing. A system that performs brilliantly during a strong trend may perform terribly during consolidation. There is also a psychological trap involved. Crossover strategies feel comfortable because they remove decision-making. The trader simply waits for the lines to cross and takes the trade. This creates the illusion of certainty. But trading is not a business where certainty exists. Successful traders understand that a signal is only information, not a guarantee. They do not blindly follow crossovers. Instead, they ask important questions. Is the market trending or ranging? Is momentum increasing or decreasing? Is there a significant support or resistance level nearby? What is the broader market context? Professional traders often use crossover signals as confirmation rather than as the primary reason to enter a trade. They understand that the signal itself is not the opportunity. The opportunity comes from the market conditions surrounding that signal. A crossover occurring within a strong established trend can provide useful information. The same crossover occurring inside a choppy trading range may be almost meaningless. The hidden truth about moving average crossovers is that they are not broken. They are simply misunderstood. Traders fail when they expect the crossover to do all the work. The professionals know that the crossover is only one piece of a much larger puzzle. Once you stop viewing it as a magic signal and start viewing it as a tool that must be combined with market context, trend analysis, and risk management, you begin to understand why most crossover strategies disappoint and why experienced traders use them very differently from the crowd. One of the most important differences between amateur traders and professional traders is how they view the purpose of a moving average. Most beginners see it as a tool for generating buy and sell signals. They wait for the price to touch it, cross it, or move away from it before making a decision. Professionals, however, often use moving averages for something much more valuable, measuring the strength and quality of a trend. This shift in perspective changes the way they interpret market behavior and helps them avoid many of the mistakes that trap less experienced traders. A trend is more than just price moving up or down. A strong trend has characteristics that separate it from random market movement. It shows consistency, momentum, and a clear imbalance between buyers and sellers. A moving average can help reveal these characteristics without forcing traders to focus on every small fluctuation in price. Instead of asking, should I buy because price crossed above the moving average? Professional traders ask, what is this moving average telling me about the health of the current trend? For example, when a market is in a strong uptrend, the price often remains above the moving average for extended periods. The moving average itself begins to slope upward, reflecting the strength of buying pressure. Pullbacks tend to be shallow, and buyers frequently step back into the market before price can move significantly below the average. This behavior tells experienced traders that the trend remains healthy and that buyers continue to control the market. On the other hand, when a trend starts losing strength, the moving average often begins to flatten. Price may cross above and below it more frequently, and momentum becomes less consistent. These changes can serve as early warnings that the market environment is shifting. The indicator is not predicting a reversal, but it is showing that the conditions supporting the trend may be weakening. This information can be extremely valuable when managing existing positions or evaluating future opportunities. Another advantage of using a moving average to assess trend strength is that it helps traders stay focused on the bigger picture. Many traders get distracted by short-term volatility. A sudden pullback during an uptrend may create fear, causing them to exit a position too early. By observing the overall relationship between price and the moving average, they can better determine whether the pullback is simply normal market behavior or a sign of something more significant. Professional traders also pay attention to the distance between price and the moving average. When price consistently stays above a rising moving average without drifting too far away, it often reflects a balanced and sustainable trend. However, when price accelerates sharply and becomes excessively stretched from the moving average, it can indicate that the market is becoming overheated. This does not necessarily mean a reversal is imminent, but it may suggest that the trend is entering a more vulnerable phase. The key lesson is that moving averages are most powerful when they are used to evaluate market conditions rather than generate automatic trading decisions. They provide a framework for understanding whether a trend is strong, weak, healthy, or unstable. Instead of treating the indicator as a trigger, professional traders use it as a measuring tool. This approach removes much of the emotional decision-making that hurts trading performance. Rather than reacting to every crossover or touch of the moving average, traders focus on what the indicator is communicating about the underlying trend. They understand that profits often come not from predicting the next move, but from correctly identifying the quality of the current one. That is why professionals use moving averages to measure trend strength, while most traders continue searching for signals that rarely deliver consistent results. One of the most overlooked truths in trading is that a moving average has no meaning on its own. This may sound surprising because many traders spend countless hours adjusting moving average settings, searching for the perfect combination that will unlock consistent profits. They test different periods, compare exponential and simple averages, and look for ideal crossover combinations. Yet despite all this effort, many continue to struggle because they are focusing on the indicator itself rather than the market context surrounding it. The reality is that every indicator, including the moving average, is only a reflection of price. It does not exist independently from the market. It cannot explain why buyers are stepping in, why sellers are becoming aggressive, or where important battles between supply and demand are taking place. To understand those things, traders must study price action and market structure. Without that context, a moving average becomes little more than a line on a chart. Imagine a situation where the price is trading above a rising moving average. Many traders immediately assume that the market is bullish and begin looking for buying opportunities. But what if the market is approaching a major resistance level that has rejected price multiple times in the past? What if buying momentum is slowing down and volume is decreasing? In this case, the moving average alone is providing only a small piece of the puzzle. A trader who ignores the surrounding context may enter a trade just as the market is preparing to reverse. The same principle applies during downtrends. A trader might see price trading below a falling moving average and assume that selling is the obvious choice. However, if the market is approaching a strong support zone where buyers have historically entered aggressively, the situation becomes far more complex. The moving average may still point downward, but price action could be signaling that a significant shift is developing. Understanding this difference is what separates thoughtful traders from those who blindly follow indicators. Price action tells the story of what buyers and sellers are actually doing. It reveals momentum, hesitation, rejection, strength, and weakness. Market structure provides an even deeper layer of understanding by showing how trends are formed through higher highs, higher lows, lower highs, and lower lows. When traders combine this information with a moving average, they gain a much clearer picture of the market environment. Professional traders often start with price before they even look at indicators. They identify key support and resistance levels, assess the overall trend, and determine whether the market is trending or ranging. Only then do they use the moving average as a supporting tool. The indicator helps confirm what they already see rather than serving as the primary source of information. This approach also helps traders avoid many common mistakes. One of the biggest is taking every moving average signal as if it carries equal importance. In reality, the same signal can have completely different meanings depending on where it occurs. A pullback to a moving average during a strong uptrend may present an opportunity. The exact same pullback during a weak, range-bound market may lead nowhere. The difference is context. Markets are dynamic and constantly changing. No single indicator can capture every factor influencing price movement. Traders who rely solely on a moving average often find themselves confused when the market behaves differently than expected. Those who understand market context recognize that the indicator is simply a tool for organizing information, not a substitute for analysis. The secret is not learning to trust the moving average more. The secret is learning to trust the market itself. When you understand price action and market structure, the moving average becomes far more useful because you finally see it for what it is: a supporting guide that helps clarify context, not a standalone system that makes decisions for you. One of the most powerful yet misunderstood aspects of the moving average is its ability to reveal trader psychology. Most people see it as a technical indicator, a mathematical calculation based on past prices. While that is technically true, what many traders fail to recognize is that every movement in the market is driven by human behavior. Fear, greed, confidence, uncertainty, panic, and optimism all leave footprints on a chart. The moving average helps organize those footprints in a way that makes crowd behavior easier to understand. When price trades above a moving average for an extended period, it tells a story. It suggests that buyers have been consistently willing to pay higher prices. Confidence is growing. Traders who were waiting on the sidelines begin to fear missing out on the move. As more participants join the trend, demand increases and price continues higher. The moving average reflects this collective optimism. It is not causing the trend, it is simply displaying the psychological state of the market. The same concept applies during a downtrend. When price remains below a declining moving average, sellers are demonstrating control. Market participants become increasingly pessimistic. Traders who bought at higher prices may begin to panic as losses grow. Others may rush to exit positions before conditions worsen. This emotional pressure creates additional selling activity, reinforcing the trend. Again, the moving average is not creating fear. It is showing the result of fear already present in the market. One of the most interesting psychological signals occurs when price repeatedly respects a moving average during a trend. Many traders interpret this as the indicator acting as support or resistance. In reality, the behavior often reflects collective belief. Large groups of traders are watching the same level. They expect buyers to step in near the moving average during an uptrend or sellers to become active during a downtrend. Because enough people share this expectation, their actions can influence price behavior. The moving average becomes a self-fulfilling reference point, not because it has any magical property, but because traders collectively assign meaning to it. The distance between price and the moving average can also reveal valuable psychological information. When price moves far above a rising moving average, excitement often becomes excessive. Traders begin chasing the market, afraid they will miss further gains. Confidence can turn into overconfidence. At this stage, even good news may have less impact because so much optimism has already been priced in. Markets often become vulnerable when emotions reach extremes. The opposite is true during sharp declines. When price falls significantly below a moving average, fear can become widespread. Traders may sell not because conditions have fundamentally changed, but because they are reacting emotionally to losses. These periods often create opportunities because crowd psychology tends to overshoot in both directions. Understanding this dynamic allows traders to avoid becoming part of the emotional herd. Professional traders pay close attention to these psychological clues. They know that markets are driven by people, not indicators. Instead of viewing the moving average as a mechanical trading signal, they see it as a window into the collective mindset of market participants. A steeply rising moving average may indicate growing confidence. A flattening moving average may suggest uncertainty. Frequent price crossings can reveal indecision and a lack of conviction among traders. The true value of the moving average is not found in its formula. Its value lies in what it reveals about human behavior. Every trend, pullback, breakout, and reversal reflects decisions made by thousands or even millions of participants. By studying the relationship between price and the moving average, traders gain insight into the emotions driving those decisions. And in a market where psychology often matters more than prediction, that understanding can become a significant advantage. The biggest secret that 99% of traders get wrong about the moving average is surprisingly simple. They treat it as a trading system instead of a decision support tool. This single misunderstanding is responsible for countless losing trades, unrealistic expectations, and years of frustration. Many traders believe that if they can just find the right moving average setting, the perfect crossover combination, or the ideal time frame, they will finally unlock consistent profits. What they fail to realize is that no moving average was ever designed to make trading decisions for them. A moving average is a tool. It is not a strategy. It is not a prediction machine. It is not a shortcut to success. Its purpose is to help traders organize information and better understand market conditions. The moment a trader begins relying on it as a standalone system, they place unrealistic demands on an indicator that was never meant to carry that responsibility. This mistake often begins because traders are naturally attracted to simplicity. Trading is difficult, uncertain, and emotionally demanding. People want clear answers. They want a chart that says, buy here and sell there. Moving averages appear to offer exactly that. A crossover happens, and it feels like a signal. Price touches the average and bounces, and it feels like confirmation. Before long, the trader starts believing that the indicator itself is creating profitable opportunities. The market quickly exposes this belief. A crossover that worked perfectly last week fails today. A support bounce suddenly collapses. A strong trend reverses without warning. The trader becomes confused because they expected the moving average to provide certainty. The problem is not the indicator, the problem is the expectation. Professional traders approach moving averages differently. They understand that every trading decision should be based on multiple pieces of information working together. They use the moving average to provide context, not conclusions. It helps them identify the trend, measure momentum, evaluate market structure, and assess whether buyers or sellers currently have control. But the final decision comes from combining that information with price action, risk management, support and resistance levels, market conditions, and experience. Think of a moving average the same way a pilot thinks about one instrument in an aircraft cockpit. A pilot would never rely on a single gauge to navigate an entire flight. Every instrument provides valuable information, but safe decisions come from understanding how all the information fits together. Trading works the same way. The moving average is one instrument among many. Another reason professionals use it as a decision support tool is because markets are constantly changing. Trends become ranges, volatility expands and contracts, news events alter sentiment, conditions that favor one approach today may not exist tomorrow. A rigid system built around a single indicator often struggles to adapt. A flexible decision-making process supported by the moving average can adapt much more effectively. This shift in mindset changes everything. Instead of asking, what is the moving average telling me to do? Successful traders ask, what information is the moving average providing about the market? That question leads to better analysis, better risk assessment, and better decisions. The secret that most traders miss is that profitable trading is not about finding an indicator that thinks for you. It is about developing the ability to think independently while using indicators intelligently. The moving average becomes powerful not when it replaces judgment, but when it enhances it. Once you stop searching for signals and start using the indicator as a guide, you begin to see the market with greater clarity. That is the difference between following a line on a chart and truly understanding what that line is trying to tell you.